kia ora koutou katoa, talofa lava. Greetings to you all. Thank you, Gia, for creating this space to kōrero, talk about the ways that we can, better our impact businesses. Thank you so much, Larry, for your presentation as well. And thank you, everyone, for being here to see, what we have to say about, how we can better our impact businesses. And I'm kind of the accounting side. Backstory was, accounting is my background. And at first, when I did my studies, I didn't see any value in accounting. I don't know how money, would work, how numbers and people worked. But I soon found out that money is actually a very personal thing. And it's a very important thing for business, for people. And that kind of brought me back into the accounting sector. But yeah, that's a little bit about, I guess. Oh, let me make sure I get my presentation up so we can have a look. Who am I? I guess I have two hats on today. I've got probably my business advisory accountant hat, and I've got my co-founding member, I guess, for Impact Hub Auckland, which is alongside Gia and a few other amazing people. But I'm passionate about impact entrepreneurship, making sure that people, I guess, have the knowledge to make the most of their business, their social good that they're doing, the impact that they want to make. And so, yeah, my hope today is to equip you guys with some knowledge, not all of it, so that you guys can look into it. You can share with others, but you can also seek more advice in this arena. So if you look at probably there's probably a few, some of the problems that exist in this space at the moment. Is that there's lack of the legal and accounting knowledge for impact businesses is a little bit limited at the moment in New Zealand. It can be hard to find, and the available structures that are in place for New Zealand businesses, for social enterprises anyway, a little bit limited as well. You've got other countries have adopted legal structures specifically for social enterprises. I think in the United Kingdom, you have community interest companies. For the United States, you have benefit corporations. In Canada, you have community contribution companies. But in New Zealand, we don't really have a set entity, a social enterprise entity. So we just got to make do with what we've got. Therefore, I guess when you don't have that knowledge, impact businesses are not making the most of the opportunities that are available for them. So I think there has been talks about developing a social enterprise entity, but I guess it's still being talk at this stage, and hopefully we can get some momentum to have our own entity structure for impact businesses. So today, I guess I'm going to cover two entity structures for impact businesses. I'll look at the GST options. There's just some key things to know in regards to what structure you use, just a little bit of an overview of GST, even some of the income tax obligations, and then also preparing your accounts, just making sure that you have good record keeping, good reporting as you go about, setting up these entities, as you go about doing good. You want to make sure that your engine room, your numbers is working like a well-oiled machine. So the two entity structures, Larry actually kind of touched on the first one, a charitable company, and he did talk about actually charitable trust. So I'm going to look at two structures that kind of can exist for impact businesses, which are charitable company and a charitable trust and a limited liability company. I'm not going to cover the traditional business structures that are kind of generally used. You've got your sole trader, you've got your limited liability company just by itself, maybe a partnership. But I'm going to go into these two because I think these ones, this is where there's a little bit of limited knowledge in this space. And also for you guys individually, you want to make sure you have an appropriate structure that will depend on your particular organization, on its purpose, your activities, size, and so on. So you got your charitable company. Let's have a look. So your setup, you want to go about setting up a charitable company. It's similar to setting up a normal limited liability company. You go into the company's register, you register the name, you register under a company. Once you've registered as a normal limited liability company, you then go through the charities register to apply as a charitable company. And I guess the benefits of this is that, it becomes a tax exempt company while also being able to apply for funding. So it's just one entity structure where you can apply for funding, as opposed to, I think, the second one that I'm going to share on is where you have two entities to work through. The reporting kind of ways is that you report straight to the charity services rather than like a normal company that normally reports to IRD. A charitable company will report to the charity services. And there's some weaknesses, I guess. Well, you could say, or things to think about. It can be a high cost of entry from what I've heard. Got registration is quite difficult. The hurdles to kind of jump through can be quite arduous. And it's also just it's not a common structure used amongst, I guess, a lot in New Zealand. So to find an accountant or different services, you might need to find a accountant that specializes or knows about charitable companies. So that's just a few things to think about. And I think Jen might even, she might talk to it more, but there's a few costs, especially for someone that's just starting out. I think one of I think Sanitarium is an example of that's a charitable company, and they're quite a large multi-million-dollar company. So it's just things to think about when you're first starting out. You'll need to report to the charity services, but you won't be required to file a tax return or pay tax with IRD. So that's one of the things for charitable company. And we can answer more questions along that side as well. The next one, Larry also talked about the charitable trust. So he talked about once you've got your structure and making sure that you've got your charitable service or your constitution set up, you can also set up two entities where you have your charitable trust and you have your company. So where the business itself might be engaged in a charitable social good. So you might have your company that is achieving something that's helping the community. It's basically like an impact business. It's a social enterprise, and where it might require a grant to receive grant funding to achieve some of its outcomes. That's where it's beneficial to have a charitable trust that can apply for that funding. So the object here is to have the company conduct its business in its usual way, but if funding in the nature of grants is required, they're applied for in a trust, and the funding is then passed on to the company. So I look at you have different entity functions. So the charitable trust, the goal of the trust will be there to seek the funding. And then you have your business, which will execute the services of the charitable trust. And the benefits of that is that, of course, you get opportunities to access funding from funders, while also being able to operate as a business entity as well. The reporting side of it is that you can also, a charitable trust will report to the charities register, and a company will report to the IRD. So that's where one of the things to be aware of is that there's a little bit of compliance, a little bit of reporting to two different entities. I guess, and an initial cost to set up. There's those first initial costs when you go about setting up a charitable trust and also a business. But once you've got it set up, I think it can be smooth running. I've got here kind of an example. An example that we could use here could be, a company that provides educational training resources and programs to educators of children and young people under the age of 18. So this company might sell its services and resources are sold to schools and private teaching institutions. But then the company wants to train and help resource sectors of the community that can't afford the normal fees, so they can't pay for the normal fees. So this is an example where, hey, we might want to receive a grant, but as a company, it's sort of semi-impossible. It's not impossible actually to find grants, but it's a lot easier if you have a charitable trust to help you with that. So this is where you have your associated charitable trust that would apply for the grant, and the company charges the trust to provide the services required to fulfill the grant. So yeah, under this structure, the company gets the funding to supply the services at a subsidized or for free to those community groups that can't afford it. And then the charitable trust also meets its obligations under the grant from funders and also with the charity services. So those are just some of the benefits of those kind of two entities when you're going through, I'm just having to put my notes. Charitable, got your charities register, company register, opportunity to access funding. So those are those two entity structures there. And then you got your tax implications. So there's just some key things to know. I'm going to cover through GST, income tax, and then also preparing your account. So I'm sorry if there are some accountants in this room, it might be a little bit boring, but for those that are just starting out, especially impact entrepreneurs, it's just good to have a heads up. You don't want to miss payments with IRD, or else there's a lot of penalties and interests that you just want to know these key dates, key deadlines, and just have a little bit of a heads up so you're clued on some of those tax implications. So do I need to register for GST? So goods and services tax, it's 15%. The threshold is for $60,000. So once you start earning over $60,000 revenue, it's mandatory to apply to be GST registered. You can apply voluntarily, and there's just a few things to think about if you want to apply voluntarily. So should I register before I reach the threshold? Just think about, do you have large asset purchases during the year? If part of your business, your functions is where it requires you to have large purchases of different assets, it could be worth signing up for GST so that you can claim that 15% that GST that you get from purchasing. You also want to think about your customers. So if you have a kind of a business to business GST, you got to think about that versus customer. So if the majority of your customers are the general public, if you're earning under 60K, it might be worth not being GST registered. That way you don't charge an extra 15% on your services, because it's mandatory. If you are GST registered, you've got to bump up whatever your sales are, whatever you're selling, you add on 15%. Whether if you're a business to business, if your clients are businesses, it can be worth being voluntarily GST, because if they're also GST registered and you're GST registered, that 15%, it kind of nullifies itself. So yeah, it's just very important. Key tip when starting out, especially with the associated entities, if the company has an income more than $60,000, then both the company and the trust, if they have more, charitable trust and your company both need to be GST registered. So when we're talking about the second entity that I spoke about, where you have your charitable trust, you have your company, you don't want to have either or, you want to have both on the same level. So you want to be both GST registered, or you don't want to be both GST registered. And I think my recommendation is be both GST registered on both sides. That way, if the company is registered for GST, then it will need to charge the trust GST for providing the services. And if the trust is not registered for GST, then the GST component is lost to the joint enterprise. So it's just one of those things that you've got to think about when you're thinking about becoming GST registered. Also, as a charitable trust, when you do become GST registered, you have to have a taxable activity. So that's just something to think about as well. So it's not just the business doing all the services. At some point in the year, the charitable trust will need to do some sort of, it could be maybe you're doing your programs, your educational programs through your business, it could be worth doing 1 to 2 programs a year through your charitable trust, because it needs to show your charitable trust needs to have a taxable activity going on. Or you could be selling calendars for your clients. You could do a gala dinner. You could be selling merchandise, something that you're doing through your charitable trust to maintain its GST registration. So those are some things to think about. Methods of GST. So you got there's 2 main types. You got your payments basis and invoice basis. So payments basis is when you go to file your GST return, it's relying on when your payments come in and when your sales are paid out, or when you receive your sales and when you make payments. Whereas invoice basis, you file your GST return based on when you've invoiced. Versus when you've actually received payment. So those are just some things to think about for those 2 kinds of bases. And then you've also got your taxable periods. You got 1, 2, or 6 monthly. 2 is the standard kind of taxable period where you file every 2 months. 6 monthly, that can, I think it's after you earn 500K. Once you get larger, IRD recommends that you start to come to 2 monthly. If you've only got a few transactions through the year, then 6 monthly can be okay. But if you're regularly trading, it can be worth sticking to 2 monthly. That way you tidy your records. You have nice tidy records every 2 months, and you're kind of on top of your expenses and your payments, and you can kind of track where you're going. And we can talk, Mike, and see I haven't looked at the comments, but I imagine that there's probably some questions that we can go through regarding this kind of stuff here. So that's GST covered. We've also got income tax. So again, if there are any accountants, you guys probably already know this, but it's kind of just a little bit of a broader overview of the income tax obligations that are needed. So financial year, it always starts on, for the majority of companies anyway, 1st of April 2021 to the 31st of March 2022. That's for this financial year that we're in at the moment. You have provisional tax and terminal tax for income tax, and this would apply for the associated entities, not so much for a charitable company, because charitable company is tax exempt. Whereas for the associated entities, you'll have your charitable trust that won't need to file, won't have to think about paying tax, but your company will need to think about these key things. So you have provisional tax and terminal tax, and provisional tax is it's calculated based on previous year's income. And they kind of go, okay, because you earned this much income last year, this is how much tax you're going to pay for this year. And then what they do, they cut that up into three parts, which then you need to kind of pay, which is the next part. You got those tax dates there. At the end of the year, once you've paid those 3 parts, you have to pay terminal tax, or you might get a refund. So just depending on, you've paid your 3 parts and you come to the end of the year and they say, hey, actually, yes, you actually paid exactly the same amount as what we predicted. You won't have to pay any terminal tax. Or you've earned more than what they calculated, and they'll just say you got to pay a little top up, that's terminal tax. Or hey, you actually made less than what we expected, and you'll receive a nice big refund, hopefully. And so those are just some of the tax dates to think about. You have your 3 provisional tax dates, usually 28th of August, the 15th of Jan, and the 7th of May. And then terminal tax is in there as well. That's usually on the 7th of April. But this information that I'm sharing here, especially if you are an impact entrepreneur and you are setting up a business, sometimes it's good to learn about these key dates, definitely, but at the same time you also want to hire, outsource as much as you can. If finance or accounting is not your best bet, then it's always good to make sure you have an accountant that knows these key dates off by heart. They have it in their calendar, they remind you. Same with your GST returns, to do so. So the best way to prepare your accounts for reporting and tax. So I just got a few tips here. I think a few things to think about. You just definitely want to get good accounting software, especially for, I guess, for all entities. But I'm just thinking about if you've got a charitable trust that's got some transactions, and you've also got a company, you're going to have, good accounting software to track the transactions between the two entities. I'm biased. I know a lot of. I'm zero. I don't know too much about MYOB. I know zero kind of off by heart, so that's kind of the software that I lean towards, where I would have a charitable trust would have a zero account, and then the business would have a zero account, and then I can actually really have a good way of tracking my transactions that I use. You also want to understand the accounting obligations from funders. So I think Larry touched on it around whether you have an audit or not. That can be up to the funders that you work alongside. You got some funders that don't require an audit, but if you're starting to get into the big numbers, you definitely have certain government ministries and funders that require you to get audited by a registered auditor each year. So it's just really good to know the funding criteria and the obligations to make sure that you're meeting them. You also want to be extremely clear and accurate with the coding of transactions. So this is something that accountants do regularly. We like to code everyone's transactions to make sure that it's all going to the right place. And this is where it can be great to get a bookkeeper if it's not necessarily your strength, or an accountant to train you up, so you can get equipped onto understanding how to code, where things can go. Have clear governance policies and procedures. So that's exactly what Larry was talking about. From a accounts perspective, funders might require that kind of information. They want to look at your board minutes. They want to look at your policies and procedures, and making sure that in your minutes you're talking about those key things. And yeah, I think we talked about, if you've got your charitable trust, that's going to have its own conversation and its own minutes. And then you're going to also have your business, which might have its director's minutes. So you just want to make sure you have clear record keeping notes. So if you have a board meeting once a month or twice a month, you clearly say, this is for the charitable trust. These are the key things on the agenda item. And then maybe, hey, you have a 10-minute break and you come back and then you talk about the business, but you want to make sure that there's separate documentation, because they are separate entities. It can be easy because you might be involved in both entities, that you might just have one big conversation about the two. You definitely want to split them up and have really clear conversations, especially if you've got a board and you've got different directors as well. Just have really clear governance procedures about how you got to go about doing that. And then, of course, find a knowledgeable and reliable accountant that knows you, knows your space, understands how your business operates, so they can give you advice, that they can code, they can prepare your tax returns. Unless you're already an accountant yourself and you can go about doing that, that's fine. But hey, at the same time, it's also good to get professional advice suited to your situation.